Guys, thank you so much. We have a mixed crowd here. We have founders, family offices, VCs, angel investors here. Fortunately, we have 4 fund managers here. Thank you so much for coming. We're going to break the session in 2 parts. First section is going to be where they are writing checks and what they are seeing in the ecosystem today. And the second part of it is going to be when they are going to go out in the market and raise money. Fortunately, all of them are raising money, and all of them are coming from very different genres of investment. So I would request if each one of you could spend Bala, starting from you, if you spend a minute on what you're doing and the kind of fund you're looking to raise, and generally a basic history of what you think.
Right. Thank you, Pranav, and thanks to Let's Venture as well and all my fellow panelists. So I'm with Arkham Ventures. We are a $106 million fund. That was our fund 1 of the 2020 vintage. We are in the process of closing a $180 million second fund. Just to give you some sense on what we do, because each of us, while we are in the same space, we are different. We focus on early stage startups, pre-Series A through Series B. Check sizes, our entry is about $1.5 to $3 million. And we are thesis-oriented investors, so we really do what we call Middle India digitization, which is we focus on startups and founders building from day one a product for the next 400 million Indians, people making between 3 lakhs and 20 lakhs a year in family income. So the best way to understand this is examples of our investee companies. We have a company called Credit B, which is in small ticket lending. We've got a company called Jumbo Tail, which is Kirana store supply chain. Another company that, kind of does blue-collar staffing for factories, smart staff, so on and so forth. So our Fund 2 is very similar to Fund 1 in terms of thesis, except it's slightly larger, which means slightly larger entry checks. So I'll pass it on to these guys.
Hello, everyone. My name is Ranjit Menon. I'm a partner at Chate Ventures. First of all, thank you, Shanti, for having me here. We are an early stage focused fund. I think, possibly the India's largest homegrown VC fund. We managed about $1.2 billion. We've been investing in India for the last 17 years. We've been lucky to have backed companies like Myntra, Flipkart, Lenskart, FirstCry, and a bunch of these guys who've gone on to become extremely large over the last few years. From a check size perspective, or a portfolio construct perspective, 10% of our capital goes into seed, 65% of our capital goes into Series A and B, which is anywhere between $5 to $6 million, and then about 25% of our capital goes into expansion stage investments, essentially focused on crossovers, and that check size could be anywhere between $7 to $10 million. Traditionally, we've been focused on investing in software, in healthcare, fintech, and consumer-led businesses. And I think where we are from how we see the opportunity for the next 5 to 15 years, I think, digitization will be a big role. We will see opportunities in climate, in mobility, and so on and so forth. So very, very excited about what India has to offer in terms of startups and technology.
Hi, everyone. I'm very acutely aware that we are stopping your lunch, but please, that's on Pranav, that's not on us. Very happy to be here because I remember Let's Venture, I think, if I'm not mistaken, 10 years back. I was at Sequoia and Abik and I met Shanti for the first time and decided to partner what was, I think, one of their first ever events in India. And then from then on to see the platform they have built is actually quite amazing. So congrats to the Let's Venture team. That's fantastic progress this last decade. I'll introduce myself, but I just want to warn you that just when I speak, I'm speaking in crores and not millions. So you'll have to recalibrate yourself accordingly. We are a very different kind of a fund. In fact, we prefer to not call ourselves a venture capital firm. We are called Spring Marketing Capital. We do brand first investing. We have 2 funds. The first is a 150 crore fund. I see some LPs in the audience, so thank you. First is a 150 crore fund which writes check sizes of between 10 to 12 crores at Series B. In companies which have achieved PMF, we offer our brand and marketing advisory as part of the investment. We don't charge for it. And because we don't charge for it, we get a preferential price on the share that we buy. So it's a very different focus, perspective, and investing style. We made 8 investments so far. When I started, when I explained this thesis, most people laughed me off, saying it's not going to happen. But we're about to make our 9th and 10th investment by the end of this year. Our investee companies include Purple, Mosaic Wellness, JAR, Leverage, Edu, and Neo, to name a few, which I'm assuming you're familiar with. We are in the process of closing a second fund. It's called Early Spring. It's to back seed to pre-series A consumer founders. This fund is a 300 crore fund. We've done a first close at 210. We're raising the balance now. Fund is anchored by Godrej Consumer. And the idea is to back consumer founders and offer them advisory to scale to a Series A or a Series B stage. So that's who we are.
Good afternoon, everyone. My name is Rajiv Kalambi, and I represent Cactus Venture Partners. Unlike the seasoned investors here, we are a first-time fund. We're targeting $100 million. We are about 70% and beyond in terms of the fundraise. We target companies that have established product market fit in clean climate tech, health tech, and B2B SaaS, enterprise SaaS. So we typically come in at the Series A stage, help founders grow the business. We're looking to keep our portfolio relatively concentrated, maybe do about 15 deals, 15, 16 investments, work closely with the founders, help them in their growth journey, double down in the next round. So if we invest in Series A, we'll double down in Series B, look to exit by about C or D. So in a nutshell, that's about us, and happy to answer any more questions.
So I think, when we meet so many investors and we meet, all the funds and the founders, they have one question: when will this funding winter end? And I think what's important is to understand that all markets go through cycles, and we probably want to pick your mind. I think, Ranjit, we can start with you. You have the largest portfolio amongst all 4 of them. At what stage of the funding winter are we? Are we still declining? Will we keep declining? Or are you seeing some green shoots and probably we should be good in the next 3 to 6 months?
Yeah. So I think, again, the way, Pranav, I think we got to look at this is it's seed, Series A, and later stages. If you tend to look at the deals, right, I think there is fair amount of activity at the seed and Series A level even now, right? There are deals that are happening a bit, not as much as it used to happen, say, maybe a year, 2 years back, but there is definitely activity, right? And if you look at the amount, and we were doing this study, I think, last week. If you look at the amount of capital that's being raised or the valuations, there is not a lot of change. Okay, in fact, as part of our investment strategy for Fund 5, we actually think some of these ticket sizes at these stages will go up a little bit more, simply because money will not be available as it was a couple of years back. So, a company raising seed and in 4 months raising a Series A and 6 months later raising a Series B, I think that story will not play out for the next maybe 1.5 to 2 years. So it's always better to capitalize a little bit more. So from an investment allocation perspective, we think at these stages a little bit more capital. But where the significant changes happened is really in Series B and Series C. I mean, there's significantly a drop in the number of deals that's happened. And by the way, this has nothing to do with dry powder. I mean, there are large funds that have been raised, and they're sitting on the money. It's just that I think there was a significant fatigue in terms of the number of deals that happened in the last 18 months or so. That is one. And second, given where the markets are from a global perspective too, I think suddenly there is a certain uncertainty as to, what is the right value at which you need to get into, right? And everybody is just waiting on the wings. And so we are continuing to look very actively at seed and Series A, while Series B and above is really gone through a challenge, and the valuation drop is like 30-40% there. So again, I mean, there are multiple factors that contribute to it, but I think that's how we are seeing it.
Got it. Bala, how are you?
From our perspective, funding winter is really, it's more a market phrase, and a lot of it is who's funding winter. If you're a startup founder right now, obviously compared to 21, you're going to get a lot more, you know, yeah, you know, we love your idea and we're going to get back to you in a few weeks. That becomes a few months in terms of a VC response time. But in reality, I think good founders are getting funded. The delta you saw between 21 and 22, a lot of it is valuation reset. When you've got your LPs and you've got who reflect their allocations based on stock markets, because most institutional LPs have the bulk of their allocation in public equities. I'm sure family offices do as well. And private equity and VC is often a very small portion of their allocation. And for that portion of allocation, you are very much driven by an interest rate and stock market cycle in terms of how money keeps coming back and cycling and how IPOs happen. But if you're in the midst of investing like we are as a fund manager, we actually haven't seen any change. And let me explain that. We make about 6 investments a year. We did 6 in 20, 6 in 21, 6 in 22. So while there is a winter, there is a summer, what we really find is there are good companies out there, and what changes is the valuation at which you do deals. And some of the best investments we have made historically, I used to be at Kalari, my partner was at Helion, have been in markets where most people have been not interested in investing. So I think now to make it much more practical, I feel for SaaS companies, the markets have kind of really come back. You know, about 6-9 months ago, you know, it was trending to 6-8 times sales, but the good SaaS companies are now, you know, fetching at least 10 times in terms of, you know, their ARR. And a lot of other sectors, I think it's settling between a 25 to 40% lower valuation than it was in 21. So I think by and large, everybody's settled into a new environment and good founders are raising money.
Pranav, if I may add to that, you know, with the concept of a funding winter, basically what people are doing is they're comparing it to the froth of 2021, right? That was liquidity fueled rally, irrational exuberance, lots of investing across lots of businesses, blitz scaling, no focus on profitability, right? Now what we are seeing is, but if you compare it, the number of transactions that are happening, if you compare it to 2021, you'll say there's a 70% reduction. But if you compare it to the averages prior to that, we're not significantly off from there, right? In terms of the total quantum that is being invested and the number of transactions that are happening. So it's just a reset of expectations that one has to take into account. As Bala mentioned, you know, we actually did 5 of the 6 investments we've done so far in the 2021 vintage, right? But while everyone knows that, you know, valuations have plunged by 50, 70%, we don't know how many write-offs there have been in the market. Each investment that we have done is today 2x up.
Wow.
Right? So it's a question of discipline, finding the right company, the right business model, and then going out and investing it. So it's probably only the froth that is now being sort of skimmed off, and people are looking at the fundamentals.
Got it. Raja, you started writing checks at the peak of the market. And obviously you have a legendary career before that, and you've seen other people write checks and you kept talking about it. And when you moved there and you started writing checks at the peak and your market kept coming down and you kept writing more checks, what your learning has been in the last, say, 24 months?
Yeah, I mean, I'll actually start with an interesting anecdote. So when we raised our fund in 2020, which is really when the market started peaking, and for 2 years after that, I had an LP, at least 2 LPs, message me and say, we are very disappointed at your pace of investing. And I've saved those messages. They're good friends, so I can't tell you their names, but that's not the point. The point is, unfortunately, and I say this knowing that, you know, there are many LPs in the room for funds. I think you have to be a lot pushier with your fund managers. Fund managers who have invested bulk of your money in 21 and 20, between 20 and 22, they're going to lose that money. That's the truth. Unfortunately, people forget that the VC business only plays out after 7 years and 8 years. It doesn't play out immediately. When a fund manager celebrates an investment they have won, I think that's a warning sign. When a fund manager pays up for an investment because it's a fancy name, fancy company, fancy neighborhood, that's a warning sign. To me, those 2 years were terrible years. And everybody who has invested during that period is going to feel some pain, including us. we've also felt some pain. I mean, yes, some of us may have got lucky, but I would say the ones that he used the right word, Rajiv, which is discipline. I think you have to stay disciplined. So investors have to look at cycles as part of their life. It doesn't mean they stop investing. I'm speaking purely from a consumer perspective. This year we looked at 5 companies. I hope the founders don't hear this because they know who I'm talking about. All of them are actually overvalued. They had rounds happen in the last 6 months. It's not a surprise because these are good companies. They're all EBITDA positive. These are all being, PMF is proven, and the consumer category is hot today. The founders are superb. The cap table is great. These companies are expected to now grow 5x and they can command the premium. They've actually got a premium.
Yeah.
Forget the valuation being the same, they've got a premium. So, I mean, if you ask these founders, what funding winter? Right? Now there is the rest of the market. You raise money at the peak, you burned for 2 years to acquire customers, your core unit economics are not proven. Yes, there is no more money available for those companies.
Yeah.
The tragedy is the money is coming again. You know, a year later, year and a half later, we'll be now discussing what's the opposite, funding summer or spring, or we'll be discussing that all over again. And I think all of us are old enough to have seen multiple cycles.
Yes.
And I think having the discipline to run through these cycles is finally what makes an investor great over a longer period of time. I do believe that there is going to be a lot of pain from the investments that were made in the last 48 months. That's my personal view, like prior to June of 23. And I think this is a great time to invest. Not because valuations have plummeted. I mean, valuations have plummeted in companies that probably are not investable in the first place. You know, and you're probably trying to save the company, which is good. But I think the good companies are commanding a premium, and I think that's how it should be.
You know, we have seen, Ranjit, we have seen conversations change from, you know, GMV, CM1 profitability to net revenue to gross margins. So suddenly in a startup pitch, we're hearing a couple of founders even talked about gross margins over here. You know, I think, have you seen that change? And has your filtering mechanism changed today?
Yeah, so I mean, absolutely, in the sense that it's not from our side. I mean, at the end of the day, you know, you can talk about whatever number you want on the top, right? I mean, there are multiple rows after that comes that we tend to look at more seriously than the one on the top. It's just that, you know, the number on the top is very, very large, and that gets, you know, spoken about all the time. But I think not just gross margins, I think contribution levels and EBITDA levels, I think there is a lot more focus there today than possibly was there maybe you know, last year. And what's also changed is that, you know, investors are slowing down and doing a lot more diligence. They're taking time to look at the business, the model and everything else, which really, I mean, most of the investors, if you look at the last 18, 24 months, have been in a hurry to invest, right? So, you know, that I think there is a significant change. Right, and there's a lot more discussion as to, you know, how fast can you become profitable at an EBITDA level, right? So any company saying I'm going to take 5 years to become EBITDA positive is like, can you do it faster? And what will it take for you to do that there, right? So I think the conversations have seriously shifted to profitability or path to profitability and numbers below. And this is not consumer companies, GMV. I'm saying even SaaS companies, you know, were focused on booked ARR and not the bill number. And so, you know, now we're figuring out as to how much of that will convert. How, I mean, the book number, I think somebody was telling me yesterday, I think it will be valued only if it is converting within a 6-week period.
Yeah.
Right? I mean, anything more than that is really not taken seriously. So across you know, whether it's SaaS, whether it's consumer, whether it's any other company, there's a lot more focus on the bottom line numbers today when we talk about it. And how soon can you get it positive?
Yeah.
Right? But I must also tell you this. I was in the US talking to a very large investor of ours, and it's an LP. So this is why I think, you know, maybe there's a small shift happening here. And he said, you know, some of these companies, all of you guys are forcing them to become profitable at the cost of growth.
Yeah.
Right? And, beyond a point, you could be in a situation, you could have a handful of small profitable companies which will not go anywhere. Okay, so that was an interesting view in these times from an LP. I can understand my GP saying this is from an LP, right? So there are different views, and I took that as a sign of maybe some positive change that is coming. Like all of us, we are kind of looking for that small ray of hope, right?
That's the cue for the next thing. I think Rajiv, you're a first-time fund manager running your own fund. Obviously, you've been fund manager before. And what kind of questions are you getting?
Okay.
Because
pertaining to what? Fundraising for the fund, or
generally
related to investments?
Basically, your thesis, kind of a return expectations,
So, okay, see,
because most of the LPs would be, say, 5-10 funds they would be invested in, right? So you can't tell them a new story unless you have one story to tell.
Right. So I guess, okay, I can break this up into a couple of parts. So one is institutional investors, international institutional investors. Then you have Indian investors, which you'll have family offices and high net worth individuals. So if you break it up into two parts, institutional investors, the kind of questions we get are the typical, okay, you're a first time fund, you don't have a track record. Individually you all have, the three partners, we have a track record. So they will look at that. They'll say, okay, will you be together? How do we counter that? And that's part of a strategy. We've got things put in place, which is why we've been fortunate and managed to raise, some 70 plus million. Because they like that story after asking us that question. But many want to wait because, the way institutional investors function is they want to find a reason to decline or to say, I want to wait. They don't rush in. They're not incentivized to take calls. They're incentivized to become gatekeepers. So what happens is that they take the time. So typically the first time fund, they will not come in very easily. They build relationships with you. They want to understand you. They want to understand your investment thesis and how you're going about it. And some might bite, but most of them will typically wait for your second fund, not for the first fund. Having said that, we've of course got institutional investors, SIDBI and SRI fund and all government fund of funds who have backed us. Family offices tend to be a little bit more pragmatic. They'll compare, they will see the strategy.
More risk takers?
Yes, slightly more risk taking. That's also because the decision making process is faster because the family office, the founder takes the call. Largely, right? And of course, it's informed by the managers to the family owner, and then the decision taking is a lot swifter because if they like what you're doing, they like your thesis, they'll say yes, I'm willing to back it. The ticket sizes might not be very large. Like an institution, for them, they might not come in primarily because of bandwidth issues. They'll say, look, I need to do a minimum $10 million ticket size or a $20 million ticket size, and for that, I can't do to test it, to test the waters, I can't do a 1 million, 2 million, right? Which family offices can do. So that works better for a first time fund. So in our, we managed to raise 70 plus million with international family offices, domestic family offices, and individuals in their personal capacities who worked with large organizations. So
Bala, now you're in the second fund. You're about to close your second fundraising. You largely have institutional investors there. How different was the Fund 1 conversation and the Fund 2 conversation? Did you use the same slides?
Well, that's actually an interesting question. Yeah, we use different slides, but look, there are institutions and then there are institutions, okay? And I don't mean it in a flippant way. There are endowments, they think differently. You've got fund of funds that think differently. You've got pension funds that think differently. You've got government funds that think differently. But I think, and I'm going to answer the question with some backdrop, I think what has changed in India from the perspective of LPs, whether you're a family office or you're an institution, is that it's not 2006 or 2010 or 2014 anymore in terms of how VC firms are getting constructed. At that point in time, there were a handful of VC firms, all our past firms were some of those. And, it was one size fits all. You went out and you tried to find the best founders across different types of segments, different types of sectors. Could it be, so today, for example, you look at somebody like us, we are very focused around a thesis which institutions are betting on. So we are coming out and saying we think the biggest opportunities over the next 15 years are going to come from founders building for Middle India digitization. That is 5-6 sectors where they spend their money. Our institutions, the first fund, it was a thesis.
Yes.
In Fund 2, the same institutions want proof points, which we've been fortunate enough that we've got a pretty good portfolio that has demonstrated that this particular thesis works. So one is, if you have thesis centricity, that is a play more and more as you come in. The second is, what is your approach? So our whole approach has been, we are very measured, we do deep diligence, we do only a few investments a year, but then you better be right with those investments. We don't have a machine gun, you know, we're just going to make 3 or 6 investments a year. We better be good at that. Institutions track that as well. And finally, there is a lot of focus from institutions on how do you really, you know, institute governance with your startups, right? Which is, what do you exactly do? You know, how are you going to make sure you put 6, 7, 10 million in a company, that company is not going belly up? So I think if you take these 3 factors, when you come into Fund 2, they want to see you're doing more of the same because that's what you pitched.
Yes.
But they want to see proof points of what you've done, and it does become meaningfully easier from Fund 2 if you've been able to deliver, both for family offices and with institutions.
Got it. Ranjit, you have raised multiple early stage funds, you have a growth stage fund. And have you seen your LPs actually become like partners to you, and or you see a continuous churn in?
No. So, we've been lucky about, we've raised 6 funds so far, and about 70-75% of our LPs kind of re-up, and that's really the basis with which we start the next fund, right? It is interesting as you grow into multiple funds, the kind of questions that or the diligence that the LPs do are slightly different. I mean, Fund 1 is really about the team and the storytelling, the opportunity, and all, because you really don't have anything else. Right, but as you go across to Fund 2, 3, and 4, obviously the track record is critical in terms of not just TVPI or what's the NAV equivalent, but actually how much cash is being returned over and so on and so forth. The second one is how consistent you are in identifying winners, right? I mean, you could always get a company doing really, really well. You could get lucky with that, right? But if you have 5 funds, and you'll have to show saying that across funds, I have figured out a way that there are 5 companies that are doing really well. And what is that process, right? The third piece to this is in terms of institutionalizing the whole fund. I think when you start with 3 people who are getting started, the founders and whatnot. But as you go into Fund 4, Fund 5, you're saying, okay, is there a team that is there beyond these the founders? What is the processes that are there inside? What is the reporting like? All of those also start becoming critical from a diligence standpoint, and not just the fact that you got one winner. And the end of the day, this business is really about identifying those winners, right?
Yeah.
In a year, I always say, in a year, if you have 100 deals that have happened, you did all the 99 but missed the flip card, right? It really becomes extremely difficult, right?
Yeah.
So you just need to have a process in place which is very consistent and is showing results, saying that I'm able to identify 5 or 6 winners across funds, and that is super critical. And that can happen only if you're consistent, I think. We were talking about discipline earlier. It doesn't happen if you switch off and then, because this doesn't work like that.
Doesn't work. Raja, last question for you. Lunch is open already. You have Godrej, you have Cipla as LPs, and they're writing significantly large checks compared to what they might have done. What took you there? How did you convince them? And what are the theses you?
I think ours is, again, because we are very specific, because we have chosen our category, we've chosen our entry point, we've chosen our business model very, very, I think very carefully and in a very focused manner. It's going to sound very brave, but actually the early spring fund that we are raising, which has Godrej and Cipla, has not been difficult to raise. Simply because I think it's very easy for people to say, I like this, I will invest, I don't like it, I won't invest. And I actually, that clarity is very useful. We don't have to wait 6 months for a response. Godrej, the conversation with them began inbound. They called us and said, we'd love to work with you. The new CEO, Sudhir, is quite an extremely well-known name in the consumer world, highly respected. He knew us from before. He said, hey, how can the organizations collaborate? We're very interested in the D2C space. Now, very similar for Cipla. And I just feel that it becomes a lot easier for people like us because it's largely self-selection. You know, there will be folks who will look at us and say, oh my God, consumer, early stage investing, we don't want any part of it. I think that's okay. I actually always boast that our fund, especially early spring, almost has no financial investors, if you know what I mean. You know, of course, it helps that we are a small fund. All our capital is actually strategic capital of some sorts. Like, we welcome founders to invest. I've had founders who've invested who've not got any liquidity. You know, they don't never taken a secondary, but they want to be part of this. They believe that we should support it. I have VCP, GPs who are investors. And they're not doing it for financial reasons. They believe folks like us are good for the ecosystem and they want to be a part of it. I have CXOs who are invested who want to help the portfolio companies post-investing. They've all tried to do this on their own. Like there are 2 family offices who've invested saying, we try to invest in startups on our own because we are interested in consumer. But hey, we can't handle the curation.
Can you connect us?
Yeah. Happy to. So, you know, for them, this is almost like a pipe into that world. It's a curated pipe. And they're like, hey, if you put us in front of these folks, we are happy to engage. We now are speaking to a couple of funds in Singapore who want to write 10 to 20 million type checks in India. Again, are scared to do it directly. And they feel that if they are part of a fund like ours,
It makes sense.
their ability to actually get to know these companies a little better, also because we get operationally involved, is better. So, long story short, I hope the remaining 100 crores is, I still maintain this stance. But for us, it's largely been self-selection. It's largely been a few folks who liked us, like our thesis, want to work with us. It helps that we are focused. And whenever I say this, I'm always told, oh, we've heard this before. We want to keep raising small funds, which is really our strategy, what works for us. You know, it's reached a point where I say this to the LP and the LP starts laughing, saying, everybody tells us this, and the next thing I know, you'll come back to me for 100 million fund. And I'm like, no, I won't do it. So that's why, you know, I'm happy saying it in a public forum. So you can hold me to it at some point. But yeah, that's our story, which is a very unique story.
I think we've run out of time. Thank you so much, all 4 of you, to come and spare some time in the afternoon. Thank you so much. Thanks for patience. Thank you.